All right, we've got about a minute to go until we get things started for this, you know, first stream in a few weeks. So for those of you who are waiting patiently, thank you for joining us nice and early, but about 30 more seconds and we are going to get back into it. All right, there we go. And good evening to Petty Bourgeois, the first person to break the seal on the Twitch chat tonight. So welcome to the stream. But welcome back to our weekly stock market scan stream, whatever you want to call it. We've been off for a couple of weeks, but it's not because we haven't been making money. A lot of people do get suspicious that sometimes when the markets are taking a downturn and traders get a little bit quiet, that things aren't going too well. However, we are happy to report that over the last 2 weeks, last week we made about $2,700, and the week before that we made about $707, which altogether is a profit of about $3,400. Nothing insanely impressive on its own. However, what you'll notice right here and right here is that the stock market via the S&P 500 ETF SPY is down over 5% in just a 2-week time span, which is a very, very sharp drop off. But let's get back into it. A quick rundown of what happened last week, what we did well, what we didn't do so well, and then we'll talk a little bit about the upcoming week, talk about some earnings, and if there are any other concepts or ideas or points that people want to hear covered, feel free to throw those in the chat, and we will be happy to cover those on the stream. So top to bottom here, Snow, the 110 strike put, we're not really worried with that. Why is that? Because it's a June 17th expiry. Snow is trading at 141.49. They do have earnings this upcoming week. I believe they report on the 25th of May. And that's kind of going to decide our fate for this trade right here. But again, 644, meaning down here, it starts 644, ultimately meaning there's still $644 we could squeeze out of this thing over the next 3 to 4 weeks. So perfectly happy with that one. And as we know with our strategy, if it does go down below 110, all it means for us is that we get Snow at a very good price and a price that we're very happy to take assignment of it at. And then we'll move from there. Coinbase, the 70 strike put is hanging in there a little bit, and this is an interesting one that we haven't had the chance to talk about because we weren't streaming for the last couple of weeks. But we could take a look at it and look at what we've done, right? So when we first got into the trade, it was on April 29th. Coinbase was trading at $121 a share. Since then, Coinbase has dropped 45.33%. But if it stays right where it is at 66.15, we're only going to lose $5 on the trade, which, honestly seems kind of insane for something that has dropped so sharply. How did we manage that? And, the first part is always what we would like to do with the really, really nice cushions that we get off the bat, and that's selling that 70 strike put when the stock was at 121. Excuse me. And then with that, there was a big dip in Coinbase. If we look at the chart, it did go back down to about mid 50s at one point, which is not the greatest thing in the world. But we did take that opportunity to sell a 50 strike put. We got $2 of premium off that, which takes our break-even price down from 68.25, the initial break-even, is 66.2. So between now and June 17th, as long as Coinbase is above 66.2, we're going to make money on this trade despite the fact that it's dropped 45%. And that's the reason why I like some of these longer-term cash-secured put trades so much, is because of that fact. The fact that we've had this huge drop, yet we could still reasonably make money. And that is why we get into those. We made some big mistakes at the beginning of the year with Roblox and Affirm, where we ran into similar situations. However, we had 15 contracts apiece on these things, so we weren't as easily able to manage the downswings on these trades. And it looks like Petty Bourgeois is saying we've got a little bit of a video lag on this one. Audio is working fine, but video is a couple minutes behind. I will say I'm monitoring it on my phone, and it looks like the video is keeping up on the Twitch stream for me, so maybe refresh on your end. if you're having any issues. But if anyone else watching is having issues, feel free to let us know, and then we could maybe look into restarting the stream, lowering, frame rate or something like that, and doing something to get the video up to where we need it to be. Robert in the Twitch chat, how's it going? Thank you for joining us tonight. But that's all we got to say about Coinbase. One of those where, it sucks when a stock that you have a bullish position on drops 45%. That goes without saying. However, we're still in a position to make money. And if Coinbase recovers to 70 or above over the next few months, or not next few months, next few weeks, we can make $380 on the trade overall, which is not too bad of a deal. But again, that's why we like to use some of these strategies, because the bear market that we've seen so far is super, super volatile. We've seen some big swings down. So the best way to combat that is by giving ourselves some really, really big cushions. And we did that via a 45.29% reduction of our break-even price. Carter, what's going on, man? Welcome to the stream. Going further down the list, Carvana is one that we got out of this week. Now, I said that I like the June cash secured puts because of the big cushions they give us. Excuse me, just ate dinner. Got a little burp right there. But I liked Coinbase. I liked Snow. Carvana is one of those where technically the price was okay. We got out of it when it was trading at like 40, which when it was trading at 40, you could say, okay, well, as long as it held 40, we'd hit max profit. But last Friday, or I guess 2 Fridays ago at this point, 8 days ago, they released an investor presentation which had some really, really interesting slides. And when I say interesting, it's not a good thing. It was not a very good investor presentation. After reading through it, I really was not comfortable with holding on to Carvana. And as a result, I dumped it. And I dumped it for $50 of profit during that week because it opened green on Monday. And, not every trade, we don't need to win every single trade to be successful over the long run. That should go without saying. And while we do want to win every single trade, obviously, there's sometimes where it's smarter to just take our money back, move it into somewhere that we think is more advantageous over the long run. And if we look at Carvana, specifically the 40 strike puts, and if we pop CVNA in here, what we're going to see is that these June 40 strike puts are now trading at $9 and roughly 80 cents a pop, meaning that we saved ourselves about $100 with that decision so far. So happy with that. And if Carvana goes back above 40 by the end of June, and then we are in a situation where we could have said, we would have had max profit, that sucks, but it really wasn't worth for me the risk of holding on to these 40 strike puts when I really wasn't too confident in the stock anymore. Shopify, really similar idea to Coinbase and Snow. Above it, 220 strike put. Shopify at the end of the week was trading at 363. They don't even have earnings for the upcoming week, so in plain English, this trade is one where we're going to make about $300 more on it, just provided that Shopify stays above 220. It's at 363. So we're making $300-ish more as long as Shopify does not drop another 33% this week. So that's really not too bad at all right there. Affirm, that one is, objectively did well. It was looking a little better before it dropped, 3.46% on Friday. However, we overall sold a 27.5 strike put and a 20 strike put. Those netted together for a profit of $1,595. Good stuff. Mission accomplished. Great success with the firm right there. And the idea with these different strikes is that going into the week, I think a firm was trading at roughly $23-ish a share. So what we wanted to do was we've had a lot of success with the covered strangle approach in these super, super volatile markets. So what we know about the covered strangle is that you sell an out-of-the-money cash secured put, which we did right here with the 20 strike put, and then you want to sell an out-of-the-money covered call. However, we didn't have shares, so how can we do something similar to selling an out-of-the-money covered call? The answer is selling an in-the-money cash secured put, because as we know from experience, an out-of-the-money covered call on shares is the exact same as an in-the-money cash secured put when sold at the same strike. So by selling an in-the-money 27.5 strike put expiring May 20th, we have really made the same position as if we had shares and sold a 27.5 strike call. So in a sense, we've synthetically created a bit of a covered strangle here, and it's been really, really great. The result right there, net profit of $1,500 or $1,600. And why do we like these covered strangles so much? It's because on a stock like Affirm, AFRM, What we're going to see is a lot of volatility. That kind of goes without saying. This thing peaked at like 176 back in November of last year. Crazy move, but even just looking at the 5-day chart from last week, right? We went from about, looks like it opened around 2350-ish, and we rolled these before the big spike at the end of the day, so it kind of ended the week right around 2350-ish as well. So really, we had a flat, relatively speaking, 5 days, meaning that the price that it ended at when we rolled our position is the price that the stock started at the beginning of the week. And despite that relative flatness, we were still able to take home $1,600 in profit off that position, so perfectly happy with that one. Roblox, 30 strike put, that one finished above 30, took home $450, and all of a sudden you'll see how these trades start to stack up a little bit for us. That's $2,000 of combined profit right there. DraftKings actually went up for us in the face of a market decline, which is, long overdue, in my opinion, because we have been riding that thing for a while where the drops have outpaced the overall market. But hanging in there, took a nice $1,300 profit home on the shares, and we sold those 14 strike calls, which were a little bit aggressive, however, paid off. It got up to near 14, pulled back a little bit, but we still pretty much got the full premium. We closed these out for a 2-cent debit, just to make sure that we didn't have naked calls when we rolled the position to next week. And all in all from DraftKings, we had a $1,700 profit. And again, top to bottom right here, that's a $3,700 cumulative profit. But for those of you who are looking at the bottom here, you'll see that we only had a net profit of $2,700. So we had a little bit of a misstep. Let's talk about it. Fubo, we sold some in-the-money cash-secured puts because I'm pretty bullish on Fubo at these levels. So happy to play a little bit more bullish of a trade with in-the-money cash-secured puts. We lost $240 on it, but look, that's, that doesn't really move the needle for us on a week-to-week basis with how big some of this stuff is. Because even net up to this point, that's still a $3,500 profit. We had a really nice call spread on SPX early in the week that netted us $320 of profit. However, after that is where we ran into a little bit of hot water with SPX spreads. And we've been running these very, very successfully over the last few weeks. And it just shows how effective SPX, credit spreads can be in a volatile market. You'll see put spread. Last week we had 2 put spreads as well. And we've been selling these bullish put spreads in a market where SPX has, largely been decreasing. And we've been making money, which shows how effective they are. So 2 weeks ago, we had $1,800 of profit. 3 weeks ago, $2,600. Lost $614 there, and then I think the week before that we made $450. So not to get too crazy and go all the way back to the beginning of time, but over the last 3 weeks we've netted a profit of $4,256 on these SPX spreads, which have been overwhelmingly bullish, despite a drop in the market, which is really, really good confirmation that with the volatility we've seen in the market, some of the cushions that these credit spreads allow us to get, that this is a strategy that we're going to be continually trying to play. And especially since the fact that with these SPX options, they historically had been Monday, Wednesday, Friday expiries. They now have Monday, Tuesday, Wednesday, Thursday, Friday, which gives us a whole lot more flexibility in the expiries we pick, the strikes that we select, the amount of trades we can get into and out of in a given week. So I think these are a great place that we are going to leverage some profit from in the near future. And a little spoiler alert, we sold another bullish one that's on track for about $1,100 of profit, which would basically wipe out those losses from last week. And those expire Tuesday, so we could hop right back in and get even more before the end of the week, but we'll cross that bridge when we get to it. But that's kind of what happened to us. You'll see this 3% drop in the market. We actually got scared out of these a little bit, admittedly. These would have finished at max profit if we had just held on. However, with these SPX spreads, it's really, really important to not take a max loss. And that's kind of the situation we found ourselves in. It was like 1 p.m. The price of SPX was below this. It was at 3.4. We said, okay, let's just take our money. We'll take the loss because like a $1,500 loss, well, yeah, I would prefer not to lose $1,500. We made $1,800 off these spreads last week. And if we had let this go a little higher, we would have lost, upwards of, $2,000, $2,500 off of SPX, which would have been a little bit more difficult. And the trade-off is, HT, this sucks. We should have held on. We would have made this money back. But what I did immediately was roll into new SPX spreads, which gave me a little bit bigger cushion and a little bit longer of a time frame to wait, right? I rolled into these 524, 3730, 3740, and you'll notice that even though we lost 1,200 on the ones that we took a pretty big hit on, These are going to deliver us about $1,100 of profit should SPX finish above 37.40 come Tuesday by market close. And if we look at futures, it's at like 39.40 right now. So we have a very, very nice, I guess we're on track for a very, very nice cushion come market open Monday morning. And with how volatile the market has been, I think pulling up the SPY chart would be a very, very good way to illustrate just how volatile the market has been. I mean, look at this. We saw on Tuesday, I believe this was May 17th, we were topping up. We were, knocking on the door of 410 again. Yet by end of day on Wednesday, we're back at 390. And then we had a relatively flat Thursday. And then Friday, we had a nice green candle. It opened up to 396. We had those spreads that were down at like 384. We said, okay, we're good. We're in the clear. And it wasn't, it was barely 1 p.m. before it went all the way down to 380. A move from 396 to 380, 16 points knocked off of the S&P 500 ETF SPY, which historically is just an insane move that we do not, quite frankly, see. But in markets like this, we have to keep in the back of our minds that these types of moves are definitely possible. Now, it did rip back upwards and go above the 384-ish level that we sold, which is, where a little bit of regret comes in, but we're never going to regret making what I perceive to be an intelligent decision. And while you may regret one afternoon, oh, I should have done this because this would have happened, rolling before you hit that max loss, just keeping the train moving is the smart decision. And while the smart decision may make you regret one little move in an afternoon, the smart decisions are going to lead to long-term, sustained success in the market. And flipping over to that performance since inception tab, that is what we've seen. Despite, the big run-up in 21, the big drawback in 2022, we are still outperforming NASDAQ and the S&P 500 by a very, very tidy sum. And we are going to hope to keep that up as we outperformed by 5.07% last week and 2.88% the week before that. Now, full transparency, and we love to be transparent here because, it's not all fun and gains when you are trading in the market, right? We dug ourselves a massive hole in January by, lighting about $40,000 on fire. And seeing $37,000 loss in a year, you might be new to following us. You might be new just tuning into the stream right now. You might say, HT, that's a pretty sizable loss. Like, what's going on here? But if you look at 2021, our weekly tracker, the year-to-date summary, we made $94,000. So the numbers we're trading with are a little bit bigger. It might be a little bit intimidating to see that we've, given back about 37K of that. But it's important to keep in mind the context of the market that we're trading in. We use a little bit of leverage. And what we have seen, I think objectively, there are some articles coming out about the performance of the S&P 500 and NASDAQ. I think what we've seen is the worst start to a year for these indices since the Great Depression. And that is an insane stat and just goes to show you, give you a little bit of perspective of how tough things have been. So if you're even just hanging in there, and if we go to our year-to-date summary, we are hanging in there. So mission accomplished. Just hang in there during the downturns because as we saw in 2021, we know what a little bit of leverage and what this strategy can do when things are a little bit more smooth sailing in the market. I mean, it's crazy to look at 2021 in comparison to 2022 because the worst month the S&P 500 had in 2021 was a minus 1.41% month. I mean, we've had multiple weeks that were 2, 3, 4x times worse than that. So it's been a rocky road. But, let's look at 2021 again, right? From June until December, how much money did we make? We made $48K off of, a relatively flat-ish market. A lot of the S&P 500 gains were kind of in the front end of the year. We made, what's the number again? $48,000 between June and December. So if we go back to what we're down right now, 2021 or 2022 year to date, that would put us at a $10,000 profit for the year. And if we could, navigate and survive a year like this with any sort of profit overall on the year, I think that is a major success and really just hammers home the effectiveness of the strategies that we're using in the market. And we've been hammered on some of these, right? You go to DraftKings. DraftKings has dropped 61%. Fubo has dropped 81%. Roblox has dropped 66% on us. Affirm has dropped 69%. These aren't just normal 20% or 30% drawbacks that we've had to face. So we've had to face a big market pullback intensified. We faced market crash-like conditions, and we're still hanging in there with the overall market, which is what gives me confidence in our strategy overall. But moving further down the list, those SPX spreads, while we didn't profit off those last week, We're going to stick with those because we really, really like the way that they line up. We like the big cushions that they give us. And historically, they're making us money this year, which is, more than a lot of strategies in the market can say right now. I can guarantee you that. Boeing, we swooped in on Wednesday when the market was getting hit really hard, $140 a profit there. Netflix, we know that one's similar to these other June 17th expiries, where as long as that hangs above 170, we're going to grab about $800 more. Rite Aid, 562, hanging in there, and Rite Aid is a fun one because this is one of our IV reversion trades that we were alerted to in our Discord server. Quick plug for the old Discord server, and people may be telling me that the stream is messing up in the Discord server. No, we're good. We've got some family pictures. Good stuff. All right. Love to see it. But what we have and what we love in our Discord server are the alert bots that we have. So typically, when we see big spikes in the stock that give us the opportunity to enter into an IV reversion type trade, and if you're new to the stream and saying, what is that? You can go to our YouTube channel. We've got a video on the strategy, but we get alerted as they come up. Similarly with stock halts, and this one has almost been a little bit more interesting for me because there's some very, very interesting option pricings in and out of stock halts, which are alerted here along with when those shares resume trading. So that's been super helpful, but all that to say, Rite Aid is a trade that we got from there. And the stock was trading on April 20th at $9.88. We sold 7.5 strike puts for 17 cents, which is a 2% ROR. And something that is, very, very nice. I'm not mad at that trade at all. It objectively was a solid one. However, since then, we had to roll those down for roughly even money. We rolled these down for a credit of 7 cents, which, continually lowered our break-even price week after week after week after week. And now on Friday, even though Rite Aid in less than a month, or I guess it's been about a full month as of last Friday, Rite Aid has dropped 43.12%. Yet we're hanging in there with only a 260 loss right there and a break-even price of 588. So good example of how you can just keep hammering away, and eventually some of these things are going to come back to life. But that's that one. We're hanging in there. Bed Bath & Beyond. I was really thinking about trimming this one last week, so it sucks that we gave back about $900 on this. But objectively, I still like the way the premium sits. So I'm going to keep riding these shares a little bit. You'll see that we sold 9 strike calls for the upcoming week. And I'll get to this when we talk about the upcoming week. So we lost a little bit of money there. ALVR, we lost a little money, but I really like what we've done with ALVR with taking assignment of the shares. We'll talk about that when we talk about the upcoming week. CVM was a great one, another IV reversion trade. We type in CVM on the chart, and I think I'm going to have to go to the 20-day to see this one. But where do I have to go to see this one? There you go. I think this is when we entered into the trade. It was a while back in April, a month away. So you see the big spike up to 611. We sold 3 strike puts because that was a long way down. And along the way, yes, there was this huge red candle to get it back to 362 over the next few days. It bled down below 3, and we're like, oh no, an IV reversion trade, that might be a loser. It's down to 250. But with some of these longer-term expiries, and one of the reasons I like those June expiries so much is that, with CVM and this May 20th expiry, even though we entered the trade on April 18th with a really, really big cushion, and our cushion was given up, come May 20th, it was back above 3. These expired worthless, and we hit max profit overall on the trade without having to do any sort of management. We probably did a little bit more worrying than management along the way, but, it's all the same. $300 of profit in our pocket last week from that one. Open Door, and while we lost $190 on this one, this is another trade that I really, really like what we did. I mentioned earlier that we added Boeing 114 strike puts on Wednesday afternoon when the market was down like 3%, which is a crazy number. But we like to see those big red days in the market because we keep a little bit of cash on the sidelines intentionally in order to enter into some of these opportunities. And one of those opportunities that I entered into was the Open Door 7 strike puts. Now, it was trading for 712. Let me go to the tab. It was trading for 712 when we entered into the trade on Wednesday, May 18th. We sold 7 strike puts for 22 cents, meaning we had an initial break-even price of $6.78. And while Open Door went down to $6.85, and it was lower than that when we rolled the position, otherwise it would have been a winner off the bat, we were able to roll for a 24-cent credit, same strike. So what do we know about when we receive a credit and we roll? It's a direct reduction of our break-even price. So our break-even price went from $6.78 down to 674. And just like that, in a very short turnaround, right? We entered this trade on May 18th when the stock was trading at 712. By end of day on Friday, May 20th, our break-even price was 8.15% lower. And that is a really good example of how if there's a little bit of volatility, downward volatility in the middle of the week, Tuesday, Wednesday, Thursday, you can enter into these really short 2, 3, 4 day till expiry trades. And if they don't work, yeah, we lost $190 off of the bat there, but we're able to take that volatility because it dropped even further, it kicked volatility even higher, and take advantage of that to flip to the same strike next week, take that credit home, lower that break-even price. Now we're in a position where if it stays flat, Open Door would have dropped 3.79% over the course of about 9 or 10 days, and we'd take home a profit of $310. Even better if it goes back above 7, we'd make $460 overall on the trade, which is really, really nice for a 10-ish day trade. And that's why we love the HT wheel. That's why we love selling options, and that's why we love keeping some cash on the sideline to take advantage of volatility when it presents itself. The other one is Wayfair. That was another Wednesday afternoon trade we entered into. 55 cents off a 45 strike. Put is a little bit over 1% ROR. That's the magic number that we like to target because it gets you up to a really, really nice number annualized. And the very last thing on here, one thing that went really, really well for us last week, were the SoFi 7-strike puts that we sold. And we just showed the tab for Open Door where we talked about using the HT wheel strategy when a trade moves against us, knocking that break-even price down week after week. We only have 2 weeks here, so it's not too long of a list. We talked about Rite Aid, where we've been knocking it down for 4 or 5 weeks. Let's talk about SoFi, where we've been knocking this thing down for, what's the count here? 10 different weeks. So we started this trade on April the 1st, April Fools, with SoFi at 9.35, and it was a serious April Fool because that week, SoFi got absolutely crushed, right? We sold these things for 21 cents off the bat, giving us an $8.79 break-even price, but they were worth $1.06 at the end of the week. So a trade where we were just trying to target about a $210 max profit turned into an $850 loss, which you might say, gasp, not good, that's horrible. What do? Well, what we did was we rolled down, off the bat, we added an 8-strike put. We typically, the conventional wisdom here is, especially with stocks like these where there's a lot of volatility, and there's a lot of volatility just in the general market right now. What we like to do, the conventional wisdom, is to only enter into about a half position. And with Open Door, we have the capacity to double down. However, we don't need to double down. Why is that? And the answer is because the break-even price that we were able to give ourselves by rolling the existing position is lower than the stock price. Now, sometimes you'll have, situations where the stock price runs lower than your break-even price, and you kind of need to pull out all the stops, so to speak. Doubling down on the position, getting to a full position size is a great way to do that. So that's what we did. So right off the bat, we sold the 8-strike put. It knocked our break-even price down a little bit, added the AP to the early strangle, and then we rolled that entire position forward because, SoFi kept dropping. We rolled to the same strike, 8-strike put, and then we rolled the 9-strike down to 7.5. All this to say it's probably going to be pretty confusing if I go line by line by line here. But even as we were rolling down to 7.5 and 7, we had a cumulative loss of about $2,400 on this trade, which really just happened in a very short time frame of about 3-ish weeks. And I could pull the SoFi chart up to better illustrate what's been going on over the last trading month with this one. Let's see if the 20 days is enough to catch it. It is not. Let's zoom back out to the 180 and then come back when it was around. Let's see, when did we enter this trade? We said April 1st. April 1st is right around here. So there we have it. We entered in right around here, and it was basically a straight line down to 482 at the lows on May 10th. And that is when we were feeling pretty down bad. It was not the best. We rolled these things down to 7.5 strike puts, and that was for 422, which I think lines up to right around here. And that got our break even down to 7.5. We had the 7.5 break even with the shares trading, below 550 a piece. And we were saying, okay, this sucks, but be patient. We believe in the investment because, look, it sucks when the stock's going down and you're losing money. But what we like to talk about with these stocks is all the losses that we have right here until we have finished the position. These things are temporary, unrealized losses. We were temporarily down 2,400 because we're going to stick with it. We're going to believe in it. And we got a nice little bounce because that's just how these things work sometimes. You might say, it's kind of lucky that SoFi bounced from 42 to 749. By the same token, I would argue it's similarly poor luck that SoFi went from 10 to 482 in less than a month. And still, overall in the trade, let's not lose sight of the fact that SoFi is still down 19.89%. But walking through this, we just kept rolling these 7-strike. Roll it, because every little roll that we had, you'll see here where we denote that we rolled like the quote-unquote strangled down because we had a double position. But every time it lowered it a little bit more. And while SoFi was down around 5, we didn't get a ton of credit here to lower it. We only lowered it from 761 to 75 and 75 to 732, which isn't a ton of progress. But eventually, as SoFi came back up, there was a little bit more extrinsic value in these 7-strike puts. So we just kept rolling the 7-strike puts. And all of a sudden, at the end of the week, last week, after 2 solid weeks from SoFi, we're at a cumulative profit of 250. We could have let those expire worthless, finished up SoFi, and said, you know what? We made money. We did it, despite the fact that SoFi is down 20% in the month and a half that we've been playing it. We made money. However, there was still a lot of premium on those 7-strike puts. So, you know what we did? We said, okay, let's just keep the train rolling. Let's keep the HT wheel rolling and just keep selling these until they, don't have enough premium for us. And now that there's more premium being pumped into these prices are being dropped more aggressively. We've gone from a break even of $8.79 off the bat to $6.59 as of last Friday. And if we could keep selling 7-strike puts for about 30 cents of extrinsic value, that's going to be another 30 cents we knock off next week. And if it doesn't fall back below 7, we're at that $810 profit. And we could do the same thing. We could say, you know what, let's sell these again. Let's bag $560 more of profit and just keep the thing moving. I think it's kind of been one of my personal goals to get one of these break evens below 0, because it is possible. But, typically we end up taking profit and making money and moving on to something else before that happens. However, it's a goal of mine, so we may try to do it right here. Who knows? DraftKings, a great example of how long some of these things can get, right? We looked at Open Door, we looked at Ride It, and we just looked at SoFi, or you might say, 4 or 5 weeks seems like a long time. Here's a great example of what happens when a stock can drop 61% on you, as DraftKings has done. This we've been playing since the end of November when it was at 36 a share. And despite the fact that this thing was at 36 a share and is now at 14, where it's dropped 61%, to reiterate, we've just been knocking, in column N right here, we have the amount that we've knocked off our break-even price each week. The average is 50 cents. Which may not seem like a lot when your stock is down, $10, but if you just keep knocking 50 cents off, 50 cents off, 50 cents off, think about that over the course of a year. With 52 weeks in a year, if you knocked 50 cents off of your break-even price every single week, you're knocking $26 off your break-even price over the course of a year. And what we can't emphasize enough is that we're long-term investors. So we're happy to keep waiting, right? DraftKings, we've, keep knocking it down. Low 30s, high 20s, mid 20s, low 20s. We finally cracked the 20 mark at the beginning of April, and now we're down to 17.51 as of market close last Friday. Now we're in 14.5 strike call, so we can't exactly get it back even. However, we're getting closer and closer and closer every single week. And again, with that patience that I'm talking about. Because 3 months ago, back in February, our break even was at like 24. Now it's at 17. We shaved $7 off. And there's nothing to say that 3 months from now, come August, we can't have a break even of about 10 a share. So that's what we try to look at. And by the end of the year, this is one really just out of principle I'd love to keep up until the end of the year, just to show with the patience how we can turn what at one point was like, I think we were down 15, 20K on DraftKings at one point, but how we can stay patient, keep selling that premium, and eventually turn it into a profit. We talk about GHIV a bunch because that was one where we did this and we kept rolling down, and it was a 6-month trade, but it turned into an $11,000 profit. That's kind of the blueprint, right, of the HT wheel. But DraftKings is something I think is really going to be similar in the long run. But with that said, really solid week last week, $2,700 profit, and it's even sweeter to see that $2,700 profit in the face of a 3.01% decline in the S&P 500, because the last time the S&P dropped 3% in a week, I can tell you we didn't do so hot. So we've adjusted the strategy a little bit, taken the foot off the gas on some of our heavier positions, kept some cash on the sideline, waited for different opportunities like we've seen with Wayfair, like we saw with Open Door, like we saw with Boeing. And then we're kind of moving from there and just taking advantage of the premium as it exists in this volatile market, which I think is offering us a lot of protection. And speaking to that protection that I feel that we're offered, let's finally get into what we've got for the upcoming week, the good stuff. You know, it's great and all that we made money the last 2 weeks, but you might be saying, HT, I'm on the stream. I don't really care about the last 2 weeks. How are we going to make money this week? Let's get into it. So off the bat, we still have these June 17 between Snowflake, Coinbase, Shopify, and Netflix. We have 4 different positions that are expiring in June 17th. Don't touch those. You know, just let them sit. You know, it's like putting something in the oven, just letting it cook. We'll come back to it, and we're gonna open up the oven on June 17th and hopefully find a little bit of profit. But again, Snowflake 26% cushion, Shopify 40% cushion. Coinbase is pushing it, but this thing's been sold off a ton, so I'm happy to just continue playing it around the mid-60s level. And then Netflix, 9% cushion. So some solid cushions there. And cumulatively, this is what? 6.44 plus 12, 309. This adds up to $29 of premium, meaning if these all stay above the strikes that we sold right here, over the next 3 weeks, we're going to make $3,000 on these from doing absolutely nothing and sitting back. Meaning we're going to make $300 off Shopify if it doesn't drop 40%. We're going to make $600 off of Snowflake if it doesn't drop 26%. You know, $800 off Netflix if it doesn't drop 10%. You get the point. The idea is we're putting ourselves in these high probability positions, and doing so in the long run, while there may be bumps along the road, in the long run, we are going to outperform the market with these strategies. So that takes those into account. We talked about Affirm when we were reviewing last week with how we split it up between a 20 strike put and a 27.5 strike put to kind of emulate the coverage strangle that we like to sell. We did something really similar here, but instead we used 21, 26. We tightened them up a little less upside on the 26, but a little bit more premium by going more aggressive with the 21 strike put on the low side. And the great part about this is up here, we calculated the profit and loss with the positions when we rolled them. And we did that at about 3:30 last Friday. And for those of you who were following the market last Friday, there was a big jump right after 3:30. So we're already seeing a little bit of profit on these positions that we opened for the upcoming week. And this is all based off of these prices, which were the prices at close on Friday. And we always say, what's the best way to evaluate the potential profitability of the positions that we're in? And the answer is to say, okay, you know, if everything traded dead flat, how much money would we make? And what we're looking at right here is the amount of money that we would make based off of these positions if they all traded dead flat. Now, you know, the market could go against us. This number could be lower, but consequently, or conversely rather, the market can also go with us and push this number even higher. But we always typically find that for an objective evaluation of what we're holding in our portfolio, just using that flat price is a good idea to get an idea of the amount of premium that we are in line to collect for the upcoming week. So with the firm at 24.82, this is what these would finish up at. We're in line for a $1,500 profit on a firm. Roblox, similar idea, but we got a little bit more aggressive here. You'll remember that we sold the 30 strike puts for 101. Roblox is a little bit lower, down to 31.6 this week, but I'm still comfortable with that 30 strike price level. $1.69 a premium is super nice. I think that's like a 5% ROR, which is really nice. And you might say, HT, 5% ROR, that seems a little bit risky. Why are we going for a 5% ROR? And the answer is that you'll notice with the firm, we have 10 contracts, which we consider to be a full size. Roblox, we only have 5 contracts right now. So this is a little bit riskier, getting a little bit more premium, but if Roblox drops, that's when we add more, get even more premium at a more conservative, safer, lower strike, and then get into a position like what we see with right here. But if Roblox does, you know, jump up and run away from us this week, we're not going to be upset. We're going to be happy that we took the more aggressive strike off the bat because it'll bag us $845, which between those two positions, $2,400 of potential profit right off the bat. Excuse me. DraftKings, this is another consequence of us using the prices from when we rolled them, right? So DraftKings, we rolled when it was at 13.3, but it finished the week at, Finished the week at 14. So we're showing 14.60 of profit on the shares, which could have been viewed up here, but either way, it all nets out the same, and we look at things on a monthly and yearly basis anyway, so it doesn't really make a huge difference. It just would have made last week look more impressive, but that's okay. So 14.60 of profit there. We sold the 14.5 strike calls, and, you know, I typically would like to be a little bit more aggressive here, but again, we rolled these things when DraftKings was at 13.3. The market was looking shaky, and I said, okay, you know, we'll take what we can get. We'll take the 32 cents of premium. We'll knock our break-even price down. We'll revisit it next Friday. Because when DraftKings was dropping down to the low 13s on Friday afternoon, I was kind of the mindset that, look, market's looking shaky again. If this thing gets back up to 14.5 by next Friday, we're going to bag another $3,000. That's a good problem to have. So if this does come back up to 14.5, or if it goes above 14.5 and blows these 14.5 strike calls away, we might say, oh no, it's running away from us a bit. But hey, it'll be a good problem to have, because if DraftKings finishes at 14.5, we are going to bag there you have it, $3,000 profit on the overall position next week. Fubo, we mentioned we want to stay bullish on that one. You'll remember that last week we had 2 sets of 3.5 strike puts, but with Fubo dropping a little bit, I just wanted to take as much premium as I can. And the idea, and especially I know Fubo's been a loser for us, and for those of you who are in Fubo and losing with me, thanks for hanging in there. It's always tough. I feel a little bit guilty all the time when I lead people into losing trades, but rest assured we're losing together, and we have a plan to get it back together. But you might say, look, if Fubo runs back up to 5 next week and has a crazy jump, I don't want to miss out on that. But we want to trade based off what is likely in the market. Is it likely that Fubo goes from 3 to 5 in a week? No, because that would be a 60% jump on Fubo. What is likely, as we mentioned earlier, is that it kind of stays in the range that it's in right now. We might see it run up a bunch. We might see it run down a bunch. But there was 18 cents of premium that we were happy to grab at a 3 strike, along with 47 cents of premium on the 3.5, which wasn't a ton of extrinsic value, but that leaves us half the position for a little bit more upside, right? Like if Fubo jumps up to 3.5 or above, that's going to expire worthless, and we're going to snag about $1,300 of profit on that Fubo trade next week. But as of right now at the base level, $640 of profit, nothing to be mad about there. This SPX spread is what we talked about last week. We rolled this one from the loser. Will help us recoup $1,100 and get us back on the back in the winner's circle with these credit spreads this year, which if you look up here has been very, very successful for us in a tough market. Got Netflix, we talked about that one. Rite Aid, we talked about. Bed Bath & Beyond, I liked the premium. If this thing gets back up to 9 and above, we'll bag another $300, which would make about $1,000 of profit off Bed Bath & Beyond next week. So no problems right there. Open Door, we talked about that one. A really, really nice roll that we were able to get on the 7 strike puts for a fat credit, and we're always happy to take advantage of that. SoFi, again, we sold that 7 strike put like we talked about. Between those two, we're in line to bag another $1,000 of profit. So while individually, what we really like to talk about in the way that our portfolio is set up is the fact that, none of these trades are like insane home runs. We're not making $4,000 off any individual trade, but we like to set us up with a lot of different, base hits, so to speak. And, some of these might be doubles. We might not be hitting singles this week. We might have some doubles with what we've seen off like Affirm, DraftKings, some of the movement there. But point being, we like to have a little bit of diversity in our portfolio because, look, like last week, some things might not work. Fubo didn't work. These SPX spreads didn't work. Bed Bath & Beyond didn't work. But thanks to the diversity and the amount of overwhelming premium that we have in the market, thanks to the volatility that we've seen lately, we had a lot of trades that did work, and it netted out to a profit. That was with the S&P 500 down 3%. We saw something super similar 2 weeks ago with the S&P 500 down 2.34%, and we still made money that week. However, if we can finally get the market to cooperate, and one thing that I do want to point out is we have 1, 2, 3, 4, 5, 6, 7 red weeks in a row. 7 red weeks in a row, and the 8th week behind that was only a 0.05% gain in the market. So the market has had a historic, skid of consecutive red weeks. So I imagine that, and again, when this skid started, the S&P 500 was at 452 a share, which is crazy. And again, we looked at that 2021 recap earlier when the worst month in the market was 1.45%. Over half the weeks over this 8-week losing skid have been worse than that, which just puts into context how rough things have been. So while we did have some hits, some misses, when the market does turn green and things start to move together, we can have that proverbial perfect week. I think if we could scroll up here, I don't know if we had one earlier this year or not, but it's definitely possible for all of our positions to work together when the market does and take us home some really, really nice profits. That one was close, I guess, to a perfect week, that 14K week we had. But other than that, let's, it wouldn't be impossible to pull off. So let's hope for a perfect week if we've got a green week in the market. And I think we're really, really well positioned to do so. There's not a ton of upside, right? Because DraftKings capped at 14.5, Fubo 3.5, Affirm 26, Roblox is already out of the money. But again, I'm not trying to hit things out of the park. The market has been so volatile, and I can almost guarantee you that we are going to have some very, very good opportunities to put some more of our capital back into the market, off of any dips that we see in the coming week. Now, if we have a little bit of money in the market and we never see a dip and we say, oh shoot, we never had the opportunity to put more money into the market, that's a win for us, because if the market didn't dip, we're going to be looking at a better number than 8-1 when we talk next time. So we're really, really happy with that. And this chart right here does have this week's projection already modeled into it, but that sticks us healthily above NASDAQ and pulling in on SPY. And, goal one is, getting back above NASDAQ, which we accomplished last week. Goal two, outperform the S&P 500. If we outperform both of those indices over the course of this calendar year, no matter what happens, I'm going to consider the year a win for us, because our goal in the end is to outperform the market. We see tons of people on social media talking about, oh, we can make you 10x your money in a month. We turned $1,000 into $30,000. But those of us who are here and those of us who have been in the system for a while know that's just not sustainable investing. You're going to have a chart where you may have a big run up like this, but I can guarantee you it's going to be a huge downfall like this. Our catastrophes look like this, and they look like this. These are two things, that are more setup and position size based more than anything, that I think, and I'm very confident we're going to be able to eliminate these types of slides in the future. If we do get them, it'll be because of a overall market decline like we saw with this one right here. I think this is a little bit more normal of a market slide. This one was a mistake on our part. This one was also a mistake on our part. This one was a little bit more market related. And that's kind of what I expect the status quo to be going forward. And I think we're very capable of continuing a run like what we saw in the back end of 2021. Because look, if the market just goes up a little bit on a somewhat steady basis, we are typically very, very well off. Now, when the market comes crashing down, we really just want to hang in there. But you're going to see stretches like this a lot more than you're going to see stretches like this. So that's what we play. And that's what we've got for the upcoming week. And I guess the last thing I wanted to talk about was the ALVR shares. Now, we sold some ALVR 5-strike puts. We sold those for, I think, like 30-ish cents on average. So technically our basis on these shares is $4.70. And it's an IV reversion trade. So one of the few losing IV reversion trades that we've had this year. However, it's not a loss yet. We still have the shares. And one thing that I think is interesting about ALVR, if we type in ALVR, is that, it's had a very, very interesting trading history over the last calendar year. And what you'll see sometimes with a lot of these biotech stocks, right? And you'll see it was back on April 20th, I think, when we entered into this. This thing ran up to almost $9 a share. And that's why we were happy selling the 5-strike. However, the mistake that I think we made there, similarly with CVM, is that we sold on April 20th an option expiring May 20th. I love the IV reversion trades, but for the biotechs, I think that is just too large of a time frame. So moving forward, learning from our mistakes, adapting the strategy to what we're seeing in the market, I'm probably going to stay away from those trades where it's a month out until expiry. I still do think that 1 or 2 weeks out until expiry is perfectly acceptable for biotech. But yeah, back to that 180-day chart. There's a lot of potential upside here, and it's a relatively low volume stock. If there's any sort of buying interest, we could see a pretty big run right here. And I think if you go to the news, you'll see that Piper Sandler adjusted the price target to $34. $34. That is insanely high from here. However, I don't think there's any, look, it would take a lot for a $3 stock to get back up to 25. I will be the first to tell you that. But the way that I look at this one is we've taken these shares and we've kind of seen how the stock has behaved. It's a little bit of a low volume, jumpy stock, so to speak. But we have so many capped gains. And look, if this thing goes down to zero, if it goes down to zero this week, we wouldn't even lose money overall with what we're set up with. So I'm actually kind of interested in the idea of keeping this thing, because what's the worst thing that could happen to a stock? The worst thing that could happen to a stock is it can go to zero. Now, if sometime down the road this Piper Sandler price target is realized and it gets up to 34, let's not forget they already had an FDA approval a month ago. But if this thing gets up to 34, I mean, not even 34, let's be realistic. But if this thing climbs back, has good news, gets to the low 20s, look what this gain looks like. It's a $34,000 gain. And again, the worst case scenario is we lose 7K. But if it gets just back up to that level it was trading at, that's a $34,000 gain. And I'm not saying that's going to happen next week. I'm not even saying it's going to happen this year. I'm not saying it's going to happen ever again. But with the strategy that we typically have, where we have a lot of capped gains, we like to hit base hits and kind of steadily build on things, having the opportunity for this kind of like move just from one little position, I think is very, very appealing. So I kind of want to leave those uncovered for now. And if we get a big jump, yes, I'm definitely the type to cover my shares. I'll probably say, oh, okay, well, let's just cover these at 5 or something. Because if we look to June, there's no volume on these things. I could cover them at 5 and take home another $400 of premium over the next 3 weeks, but is that really worth it when we've seen this stock and the way that this thing moves over the last 20 days? Or not 20 days, excuse me. Last 180 days? This is 180 days, not even the full year. October of last year, this thing was 26. We've got a bank with a 32 price target. And this is me justifying the decision to hold on to these shares for, kind of a YOLO. And it's not a YOLO in the sense that we're buying calls, that's boom or bust. But I love the risk to reward trade-off of what we're doing right here. So that is what we've got for the upcoming week. $8,100 of potential base profit, which would put us positive in May, which is fantastic because the market has dropped 5.43% in May. Last time the market dropped this much was kind of in January when we pissed away 38K. So, we adapt to the market. We try to do our best moving forward, ignoring some of the past losses because we trust that a disciplined approach is going to get us there in the long run. So we don't try to make it all back at once. I think the ALVR shares may be the closest that we get to trying to make those all back at once. But this is what we've got. So let's talk about some other potential opportunities. We haven't done a ton of scanning because we haven't had the live stream. But one request we did get was to talk about the the upcoming earnings. And let's see, we've got that in our Discord server. If you'd like to join our Discord server too and get alerts to these trades, these trades that we have set up where we're in line to make about $8,000 the next week. If you do want access to those, hourglass-trader.com. Maybe if I type in that, there you go. A little bit of self-promo here. Click Join HT Premium. It's $25 a month, less than $1 a day. For not just our alerts, but the alerts from the bots that we've set up to alert you to some of these IV reversion opportunities. You'll get every single trade we made as we make them, with some of the profits that we saw last week off there. And you'll get access to our, Discord server and the channels that we use during the week to call out different events. And we plan to incorporate a lot more alert bots. So really the idea is just to have this kind of be an information hub. One, where you can get our trade alerts, but two, where you can, make this and make yourself as informed of an investor as possible, and all for less than $1 a day. And that is a price that we do not intend to breach. So I think we got a lot of value over here, and that is the end of our self promo, hourglass-trader.com. Let's get into the interesting stuff. Let's start talking about earnings because I believe we had a question. Maybe the idea of taking a look at some earnings. So here is the list that we have for the coming week. We're kind of getting to the back end of earnings season. A lot of the big tech names, the heavy hitters, have already reported, but we still do have some residual large names that are coming up in the coming week. Right? We've got Zoom, we've got Best Buy, Nvidia, Snowflake. That's one we're definitely going to have our eye on because of our 110 strike puts that we have expiring in June. How about Box, Splunk? All these kind of software type companies, and then Costco after close on Thursday. Now the caveat that we always give is we love the Wednesday after close and beyond window. Why is that? Because we saw what we did with Opendoor earlier in the stream, right? If you're able to sell something that's like a 2-day trade this week with a lot of premium, and that's exactly what a lot of these back end of the week earnings trades are, you could flip that to next week very, very quickly for very, very nice premiums and sell yourself up with a very, very attractive break-even price. So Wednesday after close and beyond are typically top of the list for me. Nvidia, Snowflake, Splunk, Box. May have my eye on a few of these, but it's definitely one of these things where the analysis that we're about to perform, definitely perform it again on yourself right before earnings. But let's take an initial look. I think one of the best ways to do this is going to the scanner. hoping it loads. If we go, so we have high ROR puts without earnings. That's not what we want. I think we want high ROR puts with earnings. So typically we like to strip earnings out of our results because it's kind of annoying when you're looking at a list of scanner results and every single stock you look at is, oh, this thing has really high premiums, and then you do 2 seconds of research and say, oh, it's because they have earnings. What a waste of my time. But here's our high ROR puts without earnings scan. You've got it all in right there. And if you want access to the scanners and the queries that we use, so you could load these into your personal Thinkorswim module, hourglass-trader.com. That's one of the benefits. But here we go. Let's hit the scan button and let's see what we can see. So here we go. Let's sort it by ROR. And at the top, these are going to be the biggest moves that are priced in for earnings, right? The highest premiums, the biggest moves. And typically, these are some of the most attractive investments from an earnings perspective, especially in a volatile market. And what I've noticed off the bat is that we all remember Netflix earnings. It was woefully underpriced. We got hurt a little bit on that one. And it really, really started to accelerate the decline in growth stocks across the board. However, since then, we've seen the S&P 500 pull back a very, very large amount. We've seen a lot of stocks get hammered over the past 2 or 3 months. And with the volatility in the market, combined with the volatility that we see from, just earnings, there are some stocks that provide some very, very attractive break-even prices. So let's start at the top of the list with Zoom. And how do we do our analysis, right? Let's type in Zoom right here. We're going to type the stock in. We're going to go to the chart, and we're going to pull up the 180-day. We have the 180-day. Let's remove that drawing. And the number that we want to look at is right here, this MMM, the market maker move. So what this is a basically proprietary formula from Thinkorswim where they take all of these different variables and formulas that are purportedly used by the market makers over in Chicago, which should give you a very, very accurate estimation of the expected range on a stock for the coming week. So with the stock trading at roughly 90 and the market maker move at about 20, what you'll see is that that's going to give us a range of 70 to 110, right? 90 plus 20, 90 minus 20. So what we like to do here is we like to draw our lines at 110. And then we like to draw our bottom line at 70, just the low end of the range. And this is the 180-day chart, right? We've seen Zoom go from 306 down to 89. So typically, the 180-day action is a lot more within range. But then step 2 is taking a look at this range, maybe zooming in a little bit, and seeing if any of the peaks and valleys line up with this expected move. And what you'll see, which is very, very interesting, is the fact that this expected move doesn't really line up with anything. We might have to go back to the 3-year chart and extend this thing all the way to the left. And look at that. That's right in line with where it was trading back at the end of 2019. So theoretically, what this is already telling us off the bat is, one, conventional wisdom is these 2 little lines that we drew at 110 and 90, or 110 and 70. The idea is that if you sell options outside of the expected move, you're more likely to hit profit on those and have them expire worthless because you expect the stock to stay within these 2 red lines. So obviously, options sold outside of those red lines are more likely to profit. But what we always want to remember is the golden rule of selling puts, which is, even with earnings, even with, these inflated premiums, make sure you're selling options on stocks you'd be comfortable owning at prices that you'd be comfortable owning them at. And when we extend this red line to the left right here, we'll see that, the 70 level is basically consistent with what Zoom was worth back at, the mid-end of 2019. That's before their popularity took off in the pandemic. So it's a very, very potentially attractive valuation. Now, part 2 is taking a look at the actual options chain and seeing, okay, what kind of ROR can we get? And to make this a little bit suspenseful, we're going to start at the middle and we're going to scroll up, right? There's that 11.56% that we saw from our scanner. Let's start scrolling, getting down to 6, 5, and all of a sudden there's 70, a 3.89% ROR. That is a massive, massive, massive number. And especially what we like to look at sometimes is ROC, return on capital, because not all these need to be sold fully cash secured, right? Fully cash secured, it would be about, 67.40, whereas with margin, it would be 2,500, so a third of that. So basically, you multiply this by 3 to give you a 10% ROC. However, what I really, really like to do with these, and in the spirit of being very, very, very conservative, just because of how crazy the market's been, is let's see how far we can go before we get our magic 1% number. And look at this. You can get a 55 or a 50 strike put, 1.41, 0.94% ROR. That is a massive, massive value. And I, quite frankly, not the hugest, biggest fan of Zoom in the world. And, I definitely was of that opinion on the slide down from 306. However, it gets to the point on some of these stocks where enough is enough. And if you could snag Zoom at 55 a share if assigned, let's go back to that 3-year chart again. That would put you right about here. That is an all-time 3-year low on Zoom. That may have been contradictory, all-time 3-year, but it is a 3-year low on Zoom, a company which seemingly has a far greater market, or a far greater share in the market now than they did in 2019. Yes, a lot of this is the result of growth stocks just being absolutely crushed, but RSI is in the gutter. IV is super, super high. We love that intersection of low RSI and high IV because it lets us sell things like this 55 strike put. Or we can sell a couple of these and bag like $140 for Zoom earnings. So I'm a huge fan of that. So let's go back to the scan. Next thing on the list is JWN, which I believe is Nordstrom. Let's go to JWN. There you have it, Nordstrom, 2118. I think it's been around this level, for the better part of the last 180 days. Well, maybe that's an understatement. It has flown around a lot. I definitely remember getting in on the back end of this candle, which ended up working out okay. But the range right here, this is where you start to see the range a little bit better as opposed to what we did with Zoom, right? So we look at JWN trading at 2118. $4 expected move, so roughly between 17 and 25. So here's 25. Come on. Here's 17. And what we have here is another one that looks very, very nice to the downside here, because over the last 180 days, we haven't really hit below this. Now, what is kind of interesting is that this lines up with the bottom of the gap, but I mean, the top end of this really isn't lining up with any of these peaks right here, right? I'd like to see it around 30. I'd like to see it maybe around 27, but we're not really hitting any of that because there's a lot of chop in and out of this top line. So not something that I would really consider a bearish trade on, but I think it sets up pretty nicely for a bullish trade off of this 17 level, the low end of the expected move. So if we go to the 1 year, and again, we extend this thing out to the left, still not even seeing it on the 1 year. Let's go to the 3 year. There you go. The last time it was below this was at looks like really kind of the bottom of COVID, back when retailers and everything were shut down. And it got down like to the 13, 14-ish level. But looks like 17, historically speaking, over the last 3 years is not a bad place to own this thing. And again, we start to see this intersection, if you go to the 1 year chart, of low RSI, high IV. These are environments that we want to take advantage of, and environments that, quite frankly, are pretty good for that long-term CSP trade, right? If we looked at that July expiry, you could get a 3.78% return on 12.5 strike puts. And why do we like that? Because it only takes 1,200 of buying power to sell those things. And that's like a 33% return on capital in less than 2 months. So that's one potential idea. Taking advantage of these market conditions where we have super high volatility in the overall market combined with the super high volatility that earnings inherently brings to sell some of these longer term ones. And the great part about these longer term ones is you might say, okay, yeah, that's more premium, right? It's 44 cents a premium. And if I sold 10 of these, it'd be $440 a profit. However, if it goes up, I don't want to wait until the end of July to have to close these out. But the great part about this is with the volatile event like earnings in a volatile market is that if, JWN goes up or even just stays flat and, starts to chop around a little bit, the premium on these is going to be absolutely demolished. I mean, it is going to sink fast, and maybe 50% of 44 cents is better than 100% of 40. Well, I guess you can go 44 cents right here too, but the lowest these strikes go is 15. However, you could still get that magic number that we like to talk about right here, 2.46%. That's above 1%. That's a 15 strike, which is down here. That's crazy. However, we have seen, I guess I would lump JWN into kind of the retailers. We saw what happened to Target. So maybe be careful with some of those retailers. So JWN, you might say, okay, 15 might seem a little sketchy after the drop that we saw in Target. However, if I wanted a bigger cushion, right? If you sold a 15 strike put on JWN for 35 cents, your break even is 14.65. Now, if you took the July approach and you sold a 12.5 strike put for 45 cents, your break even is now $3.50 lower than that, which is like 25% lower. And you could maybe head into earnings with a little bit less stress on your plate. And again, at the end of the day, it's not like we lose all of our money in these things if it blows down below 12.5. If it blows down below 12.5, we now own shares at 12.5, which is historically, at this level, a decent place to own Nordstrom stock at. So unless, they launch into some spiel about potential bankruptcy or something like that, this is another one where using our scanner for high RRR puts with earnings has taken some of these trades with insane cushions to the very top of the list. And what you'll see a lot of the times on earnings is you'll say, oh, this people who sold options on this one got absolutely blown out. And a lot of the time you see that off these lower numbers where they're not really pricing in big moves, but big moves happen. When big moves are already priced in, I feel like we're at a little bit of an advantage as option sellers because it would take an even bigger move than the already big move that's priced in to really put us in any trouble. And again, at the end of the day, we just end up with shares at a good price that we can wait out like we did with SoFi. So really like JWN, really like Zoom. No issues so far. Snowflake, we already have a position in this one, so I will not be entering into anything for earnings, but I'd be willing to bet that with this thing at the top of the scanner popping in with the 10.28% ROR, that this would be a very interesting one to potentially get in on. 3-year chart right here, right? We saw it IPO'd back in September of 2020 for about 250-ish a share. Got up to 429, climbed again up to 400-ish a share before coming back to 141 as the air has kind of come out of the tires on growth stocks. But again, low RSI, high implied volatility. And this is the 3-year chart. If we go to the 1-year chart, I bet it's low. Implied volatility high. IV rank 100, IV percentile 100. Those are the green lights that we like to look for on in stocks like this when we're selling options. So let's take a look at what we have for the upcoming week here. And again, we can get 1% down at, we can get it down at 90, which is decent. That's a 33% drop. Plus or minus 27 is what's being priced in. And you're 50 below right here. So you're basically 2x the expected move or the market maker move right here at a 90 strike. I'm a fan of those. However, if you wanted to take the longer term approach again with July, and again, that longer term approach, comes between 45 and 60 days. Why do we like it between 45 and 60 days when we sell options? Just to reiterate, we like that because theta decay, surprisingly, for out of the money options, which is what we're looking to sell right here, is actually a little bit increased during that 45 to 60 day window, which is why we like to target that for the longer term cash secured puts. And again, you could find yourself with the 70 strike put. And if you wanted to use some leverage again here, and I guess maybe 10 is a little bit big of an example, but if we only just sold one, we'd be getting $170 of profit off of $700, which is around 25% return on capital right there in just under a couple months. Not, nothing to sneeze at, but nothing too bad right there. And, Vernon Gomes saying we're an underrated channel. Appreciate it. Appreciate you tuning in and leaving a comment. Thank you for following us. But Snowflake, love the idea of the 90s down here. Again, another one where if you want to leverage analyst price targets, I already know what's going to be here. 218, 322, 225. 218 is the lowest one that we could see right here. I don't know if we see anything lower than 218 from a price target perspective. 250, 280. And these are all since April 20th and beyond. So in the past month, all the price targets on this stock are here or above. So if shit does hit the fan, you're going to have this at 90, which is just, a fantastic place to have it. But again, another one of those where you really need to be comfortable with taking assignment of the shares, because this is a great price to take assignment at. I'd be happy with that. And again, if you don't take assignment and you just want to sell one of these things, excuse me, I hit the wrong one. This is what I'm trying to do. If you just want to sell one of these things and say, okay, I'm going to bag $100 off of 900 in collateral, take home over a 10% ROC in a week, that's also a perfectly valid approach to this. So, Snowflake, another good one that comes from the scanner. We'll do maybe one more. Burlington Cofactory, I already know there's not going to be good volume on that one. Maybe that'll be the last one we do because, typically when you see the double-digit ROR right at the money, things are going to be interesting. We see that with Zoom. We see it with Nordstrom. This is CGC. This is like a cannabis company. We can maybe take a look at this. CGC. Canopy Growth Corporation near the trading lows, right at 482. Market maker move of 86 cents, which would throw it down to about 470. Not massive by any means, but you could get away with the 4-strike puts for 1.65% ROR. And I believe we played last earnings or maybe 2 earnings ago on this, and it worked out pretty well, right? You'll look historically. These icons right here indicate when earnings are. Not one that typically moves a ton off of earnings, right? Nothing right there. You could further hammer that point home by going to Analyze, clicking on Earnings, typing in CGC, and it pulls up a quick recap for you. And while some of these candles might look big, if you mouse over them, 49 to 52, 769 to 8, 1326 to 1149. On a percentage basis, they're not huge moves. So maybe the 4-strike or the 4.5 strike for 3.33% ROR, that's another good one. I love a lot of these at the top of the list because, again, we're combining that volatility in the overall market right now with volatility that inherently comes with earnings. So definitely some to keep on your list, and I believe... so Zoom's going to be Monday after close. If you wanted to play Zoom, definitely get that one off before the bell on Monday. Nordstrom, Tuesday after close, so you'd have to get that one off Tuesday. Snowflake is Wednesday after close. When is CGC? That is the question because I do not believe that it is on... I don't think it's on this graphic. So what do we do when we don't know when earnings are? We could quickly type in CGC. Pops up here. The icons should come right up under the C's. Where did it go? Why do I not see CGC? Did I type it wrong? I did. CGC. There we go. Icons are here. Earnings 5:27 before market time. There you go. Boom. Friday morning. The best time of all to sell options at. So super, super happy with that one as well. Hey, that'll give us one a day. I actually really like that setup, right? On Monday, we'll sell Zoom. Tuesday, we'll sell Nordstrom. Wednesday, maybe we'll add a Snowflake because I like the idea of it. I already have the Junes, but what the hell? And then Thursday, we'll sell for Cannabis Growth Company because that reports, oh, here it is, Canopy Growth Company. I just suppose I was unfamiliar with the logo. But again, that's 1, 2, 3, 4 next week, and we'll sell those Monday, Tuesday, Wednesday, Thursday. So one a day. Let's try to get maybe $150, $200 at max profit a day and keep moving from there. So hopefully, but when we talk next week, we could be around $800 of profit off of the earnings. And again, that's just kind of how we add on to these things, right? We like to add the base hits. We have a base return of $8,170 this week, but again, add those earnings trades in. That number could be even higher. And again, throughout the week, on a day-to-day basis in the market, we might see examples of the IV reversion trades that get called out in the Discord. We might see some stock halts that provide some really, really interesting opportunities for us. And we might take advantage of those and add a few of those. But that's just kind of how we build things out. Just because this is what we have going into the week, by no means does this mean that this is what the ledger is going to be looking like when the bell sounds on Friday afternoon. One other scan that I like to use really quickly, and I'm trying to make a video on this one too because we've got some scanning videos, and I think I definitely want to build out that library of videos. But what I really like is the intersect with feature. So let's talk a little bit about that. So if we load our standard high ROR puts without earnings, we run that scan, it's going to tell us the highest ROR puts, the highest premium options in the market objectively sorted high to low, with DD coming in first place at 12.78% ROR at the money. Now, what does that mean? As we say, I guess the disclaimer that we love to give on these is that just because something has a high number right here does not mean it's a good opportunity, right? Carvana, we tapped out on that one last week because we weren't too happy with the company. Didi, Chinese company, which we typically try to avoid. Roblox, I like Roblox. We're in on it. Bed Bath & Beyond, we're there. But, that furthers the point that not all of these are good ideas. But the big issue that you have when you run a scan like this is it's like, great, I've isolated all these, but I have 1,000 different results, right? We have 1,062 different results. How do we isolate which of these trades, are the best opportunities? So what we like to do is add some parameters, not via the scan right here, but via the intersect with feature. And one of these features that we can add is a filter on the stocks. So we like to use the oversold stock scanner right here. And this basically just pulls up stocks that have a really, really low RSI, right? Because we were talking about these charts and we said that we love, like with Snowflake right here over the past year, we said that we love when RSI is getting beaten down and we love when implied volatility is up. The intersection of those two things is a very, very nice opportunity for option sellers. So we already know that, with this high ROR put scan, we're already going to get high IV. When IV is high, premium is high. That's kind of what this is already telling us. But let's unlock the second piece of that puzzle and say, okay, we know IV is high. Let's also add a parameter where RSI is low. And that's what we do with this intersect with feature, because now it only includes stocks that are oversold. So now we have 1,062 stocks. We're doing this live. Please don't embarrass me and not work, but let's run the scan, and there you go. The list has been cut down to 19 different names. That is quite the trimming of the list. And look, we're all busy people. The reason we love our strategy so much is that we don't really spend a lot of time trading every single week. What we like to do is set our trades up like we see in the Discord every single week. We like to set our trades up. We have a lot of activity, Friday afternoons. That's all the Friday, or I guess Friday starts here. These are all the Friday trades. Not a ton, but it sets us up for the coming week. Like you'll look before that during the week. Between Monday and beyond, this is what we opened over 4 days. That's all the activity that we had. So really not a ton during the week. What does that allow you to do? It lets you go outside, go enjoy your life, go work your job and do a good job so you can make money to put in the market. I don't know. But free time is a great thing, and that's why we like the strategy. However, in the vein of trying to get as much free time as we can while still being intelligent investors, this is a great way to cut through a lot of the garbage that comes up in the scan and get a much more focused look at what high premium options are looking like. So top to bottom, we know Riot. We know that this is a Bitcoin miner stock, which has been crazy. I stayed away at the highs up here because I wasn't a huge fan of that, but look where it's come back down to. On the 1 year chart, 684. Now, volatility isn't quite as high as it was. And we can look at IV rank right now. It's 51, saying basically that between the low and the high of the IV, it's kind of dead in the middle. This is on a scale of 0 to 100, and that's what we see with 163, right? It got up to like 2.31, went down to like 1, so 163 is almost dead in the middle of that. The other little study that we have up here is IV percentile, which is 96, and what this means is, and I think it's a little bit more useful of a study than IV rank, but if you look at the last 252 trading days, which there are 252 trading days in a year, so over the past year, 241 days had lower IV than what we saw today. Meaning that if IV were to revert to the mean, it would be much lower than where it currently is. And what do we know about when implied volatility comes back down? The option premium goes down. And when option premium goes down, we make money. Cause and effect, cause and effect, cause and effect. So we like to see IV percentile high. We like to see RSI low. Because let's look historically over the last year on this chart, right? Last time RSI got into the blue down here, it was bouncing off of 680. And it's still around 680. So again, flat in the market is good for us. We don't need things to go up. We just need things to not aggressively move against us, which is a very nice value proposition to have. But last time it got into the blue before that, looks like it bounced from 13 up to about 20. So RSI, pretty good precedent for what that looks like. I'm not the hugest Bitcoin stock guy, but let's take a look at this because the conditions line up really nicely, and I'd imagine that we see some really, really interesting premiums. And there you have it, right? You're seeing that magic number of 1% plus down at the 4.5 strike. And you might say, HT, it's kind of weird to be selling premium, 5 cents of premium at a time. But look, on a 4.5 strike, the numbers are the numbers. That ROR is that ROR no matter what. If you have commissions that cut too heavily into that, one, go to our YouTube channel, check out our video on suggestions for how to lower your commissions. But two, they really shouldn't cut in that much. We see the MMM is $1, which would put the low end of the range down to 584 for the upcoming week, which again, 4.5 is below that. And again, 4.5, if we got Riot shares at 4.5, it is still kind of a little iffy because we saw Riot was trading under 4 for so long. However, historically speaking, Bitcoin wasn't at the levels that it was currently at back, during this time frame. So, I'm not sold, right? This is a setup I like to avoid. If this chop that we saw right here was a little bit higher up near the 4 area, I'd be a big fan of. But look, if Riot is something you've had your eye on, this is probably the green light from a setup perspective. That it's something that you should get in on. And that's why I really love this intersect feature, because more often than not, the stocks that come up here are going to be really, really interesting opportunities. Now, I have no idea what on earth ROST is, but I can almost guarantee you that it's going to be a really, really interesting setup for us. Again, we're going to start on the 1-year chart to look at this thing. Huge, huge, huge red candle, and typically you'll see red candles like that off of earnings. And earnings don't even look too bad if you can read that little blurb there. I know I'm streaming on a pretty big monitor, so it might look pretty small to you guys. But earnings were estimated at 99 cents, came in at 97 cents, so it's not like the company's hemorrhaging money. Let's see what the news says. Also, this is Ross Stores. And we see, again, retail name dropped a ton. Keep that in mind for Nordstrom if you're going to be entering into that trade. Let's see, Ross Stores. Do we have any price target updates? Price target 100, price target 99, 110, 90. You get the idea. 85-ish, right? So everything is still relatively above where it's currently trading. And if we go to the 3-year chart, like the COVID low was like 60. But what we know right now over the past year, really high IV, really low RSI. So something's kind of got to give in the way of a bounce. And with this high IV, with this 99% IV percentile, option selling is a very, very attractive position to potentially take here. And you have the MMM of 582, which would put the low end of the range down at about 66. Yeah, 66. Which is right here. And coincidentally, you've got 1.58% ROR. You can go a couple bucks below that at the 64 for 1.11% ROR. But, not too bad of an idea there if you wanted to diversify into some more retail type stores. Because I know we have a lot of software, a lot of growth, because there's typically a lot of option premium in those areas. But, if you wanted to mix it up and potentially get a really good starter price at 66, the 1.58% ROR is sitting right there waiting for you in case it doesn't come back down. And again, maybe from a margin perspective, very, very nice number, 10% ROC with the margin privileges that our broker affords us on Rost. So back to the scan. X, I know, is a steel company. I don't really want to get too far into that. Rost again. Let's see if I actually just trim it to stocks and scan again. What happens? This is a much better list. It just gives us the name of these. Okay, this is actually going to work great for alerts and building out the alert bots for you guys, because this is a much more focused list of stocks. But it doesn't give you like ROR statistics, because those are like individual option statistics. However, we get a much more focused name of companies. Under Armour is on there as well. Let's look at UA really quickly. Really big drop off of earnings from 14 to 10. Another big drop last week down to 848. But another one where, this is about as good of a price as we've seen since the COVID lows. However, let's make sure people aren't yelling sell on this one. Price target 11. Equal weight rating 17. 11, 16, 15. So they definitely got cut across the board. But again, they're all double digits. We know that if we look at this thing on a 1-year basis, because it came up on the scan, we're going to see what? We're going to see high IV. We're going to see low RSI. So at 848 for the coming week, there's a 35-cent market maker move. You can get 1% at 8. I just don't know if I love that, to be honest. Lower volume. I would have hoped that for a stock that gapped down from 14 to 10 and then from 10 to 848, that we'd be able to pull a little bit more than 10 to 15 cents of premium. So not the biggest fan of Under Armour right there. Walmart, really, really similar vein as Target. And we could look at both of those kind of in tandem here. Target absolutely is taking a beating. Again, low RSI, high IV. If we look at the last 3 years, big drop off. So there's a lot further potentially go if we start to use that benchmark of pre-COVID highs to get an idea of where stocks are going to fall back to. And why do we use the idea of pre-COVID highs? For example, let's look at Square. ran way up from 84 up to 289, started falling back down. Where did it stop? Right at that pre-COVID high. So we love to use that for an idea of where these things are going to stop. So Target theoretically has a long way to go. Walmart, I imagine we're going to see something very, very similar. Yeah, long way to go, but not as long as Target. Walmart, did they already report last week? Let's see what we've got here. They did already report, and they kind of fell off the face of the earth and continued down to 119. Walmart looks like a very interesting opportunity right now at this 110 level. Again, high. Oh, this is a 3-year chart. That's why. High IV, 99% on IV. RSI down at like, what's the number right there? 16 is the number on RSI. So really, really good opportunity to get on a solid company like Walmart. You're not just throwing something at a pre-revenue electric vehicle company. This is Walmart. And Walmart is not giving us a ton of premium on a weekly basis, which honestly, it makes sense because, again, it's Walmart. There's not a ton of risk despite the fact that this thing is falling off the face of the earth lately. But the options don't seem to think it's going to fall or move much further. And we got the question, are we good with ThinkScript? I've toyed around with it a little bit, but I definitely wish I were better, and it's something I've been trying to learn a little bit because I think from an alert perspective and what we're interested in as option sellers and what kind of alerts we would want to be alerted to in the Discord, ThinkScript could go a long way with marrying up some different criteria and creating some like custom indicators that we could use, especially in the IV reversion field of trades. But Walmart, I just not enough premium on it for me. If it keeps going down, it keeps going down. But this is another one of the bigger names. And I think if we take a step back from a macro perspective and talk about what we expect from the market, if you look at something like Roblox, and you're going to see this for a lot of growth stocks, right? Went from 80, 141 down to a low of 20. That is an insane drop. It's shaved off like 70% of its price. If you go to the overall market with the S&P 500, the drop from 480 to 392 is pretty significant. Don't get me wrong. However, it's nothing crazy, right? And we have these red lines plotted from our YouTube channel video where we talked about how low can the S&P 500 potentially go if we mirrored certain corrections and drops that we had previously seen, which gives us some targets that we've already gone below. So we're definitely further down than like correction territory. I think we officially hit bear market territory before rebounding a little bit on Friday afternoon. But again, the idea is there's still a long way to go. And the overall market, which has been propped up by things like Apple, like Microsoft, which have relatively held strong as a lot of the money has flowed out of the market with these growth stocks. Things like Apple, Microsoft, and while Walmart isn't a tech company, it's another larger cap company that really hasn't felt the pain that the rest of the market has felt, right? You'll see Apple, which held up for so long before finally starting to feel the pain a bit. And when you see these larger stocks start to feel the pain, that's one of the signs that you're kind of nearing, the actual dip in the market and things are going to start to rebound. That's kind of why I've been so stubborn with the growth stocks, because I kind of felt that the larger ones were the last domino to fall. And as the money starts to come out of these, as people panic a little bit, typically the money goes somewhere. People are not historically very good at keeping cash on the sidelines. So growth stocks, looking at those valuations where the multiples have been slashed and the valuations are super, super low, I think the money is definitely primed to go into some of those names, which is why we've been so stubborn with a lot of these, and it's consequently why we've made money the last 2 weeks when the market has been down about 6% overall, which is a very, very big drop in 2 weeks. And I anticipate that those positions are also going to protect us in the future. However, all that to say, I think Walmart still can definitely see a little bit of pain, an amount of pain that far outpaces the premium that's being offered. So not a huge fan of that. So in summary, Riot is interesting. Ross Stores, potentially interesting. But the rest of them I'm not a huge fan of. But using that intersect feature can give you a much more focused list of stocks. And flipping to stocks can give you even more focused list of just tickers. As opposed to having to filter through all these little tickers right here. But it gives you a much more focused list as opposed to just the general high ROR scan that we like to look at that had 1,000 different results. But that's kind of all we got for this week, right? We talked a little bit about earnings. I think we have 4 stocks that look very, very good for option selling this week on earnings. And the other good thing about earnings is that they're relatively disconnected from the market. So if the market has a terrible week, you can rest assured that a lot of the trades that you're entering into, if they're earnings based, are going to be far more dependent on the results of the earnings as opposed to the overall behavior of the market, which has been nothing short of erratic so far in 2022. But we talked about that. We talked about some of the scans right here, and the more focused scan about the intersection of low RSI and high implied volatility to provide us option sellers with some very, very nice opportunities. And we talked about our portfolio, both over the last couple of weeks where we made money in the face of a market decline, and this week where I think we're very, very well positioned to make money regardless of if the market keeps declining or not, with a base profit of over $8,000 with these positions that we have established. For those of you who are still watching an hour and a half into the stream, thanks for joining us. We hope to talk to you again on the next stream with more money than we currently have right now. But until next time, this has been Hourglass Trader, where as time passes, we make money. Thank you for watching, you guys. Hourglass-trader.com if you want to join HT Premium and get involved with all of our trade alerts. But until then, we will see you guys next week, and we'll talk in the meantime every single day, of course, in the Discord server. So for those of you who are still on, appreciate it, and we are out.